do it, unexpected moves. Just when you thought you figured it out, you lose. Just don't lose money in whatever you do. Set a stop loss so you don't get screwed. Don't buy when others panic, sell when they are greedy. Mr. Market throws a hissy fit and cries, feed me. If you feel euphoria, it's time to run away. Sell, sell, sell and live to fight another day. Just remember, only price pays. 10 over 20, over 50, put it up, means you're heading the right way. Now get on it and buy stock. Just remember, only price pays. You'll get monkey hammered if you overstay. If the shit hits the fan, do not panic. You don't have to ride the escalator down. Simply sell and take your profit and don't get on it. Whatever you made is good enough. Stay out of trouble and don't do stupid stuff. Don't get greedy and try to pillage. The market will reward you with its overspillage. You may be familiar with the old adage about Ma and Pa retail from Bagholder Village. 10 over 20, over 50, put it up, means you're heading the right way. Now get on it and buy stock. Just remember, only price pays. You'll get monkey hammered if you overstay. Buy when others panic, sell when they are greedy. Mr. Market throws a hissy fit and cries, feed me. If you feel euphoria, it's time to run away. Sell, sell, sell and live to fight another day. Just remember, only price pays. Only price pays. Only price pays.
Now, isn't that a great way to start your Thursday morning? I think from now on, we're going to do that as our intro here. I hope you don't mind. I feel like that's quite the jam. I'm not partial at all. I just feel like that is quite the jam. And I think it's a great way to start the day, right? Get your blood throwing, your head bobbing, right? A good way to start the day. So how are y'all doing? Good morning. Good to see everybody. Good to see you, Alex, Scott. Good morning to you, my friend. JG is here. Good morning to you. Hang on. There we go. I was trying to adjust my camera. JG has a question. Early on with the questions here. Chris, I saw a post from you on YouTube talking about a mature trade have big losses and a professional bad traders or something have a small gain. Can you elaborate on the small gains part? Let me see what that was. Let's go to our posts, our postesses. By the way, the only place you're going to find me is on YouTube. I don't, screen one? Yeah, screen one. I don't do any other social platforms. It's just not what I do. All right, so let's see where that post was at. Oh, here we go. Sorry, I read that as amateur, but amateur. Amateur traders go broke by taking large losses. Professionals go broke by taking small profits. So let's break that down. These quotes that you see, these are all from Market Wizards. I just throw my face on them to try and sound smart. But to that point, so an amateur would go broke taking large losses because that's how the math works, right? Let's use a couple examples here. This slide. So a 10% loss requires 11% gain to get back to break even. A 20% loss takes a 25% gain to get back even. A 50% loss takes a 100% gain to get back even. This is where people's brains start to break. A 90% loss requires a 900% gain to get back to break even. And if your brain wasn't already broke, let's break it even further. So what does that mean? If you have a, let's say you have a $100 stock that goes down to 50. At $50, that stock now has to double. It has to have a 100% gain to get back to break even. Okay. If you have a $10 stock that goes down to $1, first off, that super sucks, but you're down 90% on that investment. And it now has to go up 900% from the $1 up to $10. That's what that means right there. And this is common. This is why 90% of investors lose 90% of their accounts in the first 90 days of trading, exactly because of this, because they don't know how to manage their risk. And then on the other side, professionals go broke by taking small profits, right? When you're in a trade, you need that trade to run as far as you can, right? If you're taking itsy bitsy profits all the way up, right, you're not going to make enough so that each loss, I should say each win, takes care of 6, 8, 10 losses. You either need, Steve Burns taught me this, so you either need a high win rate with a small winning percent, or you need a low win rate with a high winning percent. Meaning, if your average winners are 3 times the size of your average losers, then you could have a win rate of 33% and still be able to break even, right? But if your win rate is 80%, you could have actually pretty close. In fact, I'll give you a real world example here. My win rate last year was super high, yet my average win was not super high compared to the average loss. So this is my 2024 results. Here. This is my 2024 results from May going forward when we implemented the master key. My average win was 18.97%. My average loss was 17.9%. So actually not all that different. However, my win rate was 69% for the year. I had every month was a winning month except for November. Right. So because I had a high win rate, my average win didn't have to be that much higher than my average loss. But let's say I had a low win rate. Let's say I had a 30% win rate, and this was still the case here. Then no, I would be super unprofitable. So whenever you're balancing the win rates to profits ratio right there, you got to figure out what works for you. I like a high win rate because I like to be a winner. Even though my wins weren't huge, they drastically outnumbered my losses. So great question there, JG. Let's look at Alex says, good morning. Let's go, Brandon. Made it here early. It was really hard making it through the afternoon yesterday. I don't know what to do with myself other than actually work. Sorry, dude. Yeah, I had to leave early. My wife had a important doctor's appointment and I need to get there with her. So all is good though. Good morning, Christopher. C-Mac is here. Dizrich is here. Johnny, good to see you. Megatroy, Eric Brown, Carol Catherine, good evening. Hope Chris won't have his mic muted again. Double check. I'm good to go. Antonio's here. Augie, top of the morning to you. Good to see you, my friend. Peter from the Netherlands. Mikey Mike. Ashley. All right, listen. Listen, Ashley. You're probably telling all your girlfriends to come because I was looking at our YouTube analytics. In fact, I'll show you the page real quick. And I was like, something's not right here, Ashley. Something's not right here. Let me go over here to my audience tab and scroll. Yeah. This is it right here. Like, we got a problem. I looked at this earlier and it said it was 90.8. And I was like, hang on. We went from 92% men to 91% men to the last time I saw it said 90.8. And I was like, hang on just a cotton picking minute here. What are all these girls doing here? Why are we losing our share of the male demographic? But I'm really glad you're here, Ashley. Good to see you. Joe says, only price pays. Salutations from Mr. Baggins. Salty Brad is here. Let's get this bread. Peregrine's here. Joe, good to see you. Ciao, Italia. Ozzy, good morning. Robert, Dr. J. Chris' shirt must be wrinkled. Do a sound check too. It's my shirt. I don't think it's that wrinkled. I think it's okay. Good morning, friends. Hope everyone's day is off to a great start. And it's a great start because I get to hang out with you. I'll put it that way for sure. Good morning, Tim. Jonathan. General Motors. Oh, we can take a look at it. Dale Brent is here. Good morning. James, Megatroy, Rockstar Status. Yeah, I love that song. That song is so fun. James says he likes the new format. Cool. Thanks, man. I like it too. By the way, James, might be finding something in the mail in a few days. Just saying. Good morning, Rick. Good to see you. Let's see. Disney, good morning. Well, Brett's on the toilet. Nico, good to see you. Daniel, we can look at GM for sure. Augie says 19 new buy signals this morning. We'll have to look at that. Dennis, Philip, Brian. The thing is scary this early in the morning. Need some more coffee. Oh, the monkey hammer. Yeah, for sure. I like it. Mega Troy says, Alana, good to see you. Charles, Carol, Adrian, Bulldozer, Mari, good morning to you. Get monkey hammered. What kind of name is that? Although it's awesome. It's awesome. Bjornish is here. Vincent, Yannick, Scott. Only price pays. That's right. That's right. Shoei, good morning. I'm the amateur taking big losses. I just found you 3 days ago, and he's holding AMD. Well, Shoei, first off, I gotta say, I'm so stoked that you're here. If I'm helping you in any way, please be sure to tell everybody you know. That is how you can pay me back. If things are working for you, if you're figuring out the only price pays, if the outlier trend template's working for you, if you're deriving any sort of value at all, the way that you can pay me back is just by telling everybody you know. So that's why you add to winners. You absolutely can add to winners for sure. I think that is the best way to do it, in my opinion. Golden Oldies here. At what point did you say buy AMD? I didn't say buy AMD. That was not this channel. Do we want relative strength to be low on the positioning worksheet? To be low for short? That's a good question. In fact, let me pop that open and we can work on it together. So inside of our Discord, I have a position sizing spreadsheet that I put together for you. This is something I've been using for years and years and years. And this is where you can go in and you can update your account balance. Let's say you've got 150,000. And let's say you want to risk 2.5% per trade. And then let's say you're trading options and you trade around the 80 delta, but maybe trade around the 50 delta, right? That'll change things for sure. But let's say that we go with the 80 delta because that's generally where I'm at. You could look at Tesla and Coke, and you can get pretty much the same amount of risk to your trade here. Now, by design, this is less than the 2.5%. I've had people ask me about that. It's by design. I'm always a risk first trader, and I want you to be a risk first trader too. And by having your risk top of mind, keeping that as small as you can, that's at the end of the day, that's how you're going to survive. So on the spreadsheet here, we've got a couple columns here that I actually really love. This is incredible information. So first off is relative strength. So Tesla is printing at a 104 relative strength. Coke is 120 or 274. Now let's put SPY. That should be at 100. Yes. So what this means here is that Tesla over the last couple of weeks is actually outperforming the SPY. So if we looked at them side by side, which is hard to believe because I know Tesla has been like absolutely monkey hammered lately. Let's do Tesla on this. Can I do Tesla on this side and then SPY on the other side? Hang on, I have to change my screens here real quick. Multi-symbol view. So on this side, we're going to Tesla. And on this side, we're going to SPY. So while it doesn't look all that great, let me remove all my annotations here on Tesla. While it doesn't look all that great, comparatively, the average gain to average loss on Tesla is actually slightly better than the average gain to average loss on the SPY. And then let's look at something like Coke. This will be a lot more obvious here in a second. Let's look at something like Coke. KO. Yeah. So the average gain to average loss. So average gain divided by average loss. That's how you calculate relative strength. The average gain to average loss on Coke is significantly higher, 274% higher than the SPY. And we can put anything else on there. We could put Apple. Right? Doesn't matter. We're just trying to find if the SPY is our baseline, what is our relative strength compared to that? So we could look at Apple. Right? Even though Apple's weak, the average gain to average loss on Apple is actually better than the SPY. So now what is this change here? Relative strength delta. This is how much it's changed in the last week. So while relative strength is at 221, the question you got to ask yourself is it at 221 and falling? Or is it 221 and rising? Right? This is a big deal. Over here in this little spark chart right here, it shows you what the relative strength has been doing. So you can see relative strength on Apple had been going down, and then it popped up in the last week by a lot, basically 100% higher than the SPY in the last week. And like Coke is actually down. So it was 294. and now it's down by 20 percentage points right there. So if you're looking to go short, this is a great data point for you. I would look at it more in the relative strength delta. Like if something were strong, KO, were strong, and then it's getting weaker in the terms of relative strength, that could be an interesting point to be. But something that's really weak already, let's look at AMD. AMD, I don't know where that's going to pop up. Let's see. 152. That's interesting. So if we look at AMD, comparatively speaking, you can see how AMD's kind of hit a short-term bottom possibly right there, where the SPY is still bleeding, right? Does that make sense? So that's what those numbers represent. I would definitely not use that as my only data point, but it is a data point that you could definitely use. So good question there. Justin, good to see you. Shoy is at 148 in AMD. Yeah, that's pretty brutal, my friend Shoy. I'm sorry about that. But I'll do my best to help you out in any way I can, my friend. Mark, good to see you. Jim, Scott, Hans is here. Jonathan has a couple of things to say. Din is here. Arturo, good morning. Johnny, please do a teleport. Where are we going to teleport to? Where are we going to teleport to? You want to teleport to my library? Let's see. Let's teleport to the library real quick. Oh, look, we're in the library. Here's a great book I want y'all to pick up if you haven't already. Where's it at? It's on this side. Let me reach real far over here. Okay. If you haven't picked up this book before, do so. This is from my friend Steve Burns, New Trader, Rich Trader. That is my number one book I'd recommend to any trader to pick up is New Trader, Rich Trader. So Steve Burns, he's one of my mentors. And it's so funny. If you read this book, you're going to see so much of how I trade specifically written in these pages. Even the 10, 20, 50 outlier trend template is in here. There's so much in this book. Highly would recommend that over every other book ever for trading. That's okay, my friend. You're in the right place now. You're in the right place now. Oh, y'all were saying good morning, not GM. Okay, we're all learning together here. All is good. All is good. The song reminds me of all your rules in trading. I know, that's why it's such a great song, right? The lady boss is here. Phil, good to see you. Nate, let's look at ESAC. Good to see you. Yeah, I have a stock I'd like to see excel. Yeah. Yeah. I see what Joe's doing there. That actually, you know what? You guys are clever. I like he did that. So first you're like, wait, what are they talking about? I have a stock I'd like to see excel. Really excel? Excel? Sell. That was well done, you two. Did you all plan that together? That was funny. George, good to see you. First time I caught you live. What are the live times of what's your site? Well, first off, the site is outlier.com. You can see it right there. But the live time, 7:45 a.m. Central Time. Right after I drop my son off from school, I come right back here and jump on. The afternoon time is 2 p.m. Central Time, last hour of the day. Neo said, or not Neo said, but Brett from the Porcelain Throne this morning said that Neo got monkey hammered at 5:50. I actually don't have an order block on that. I don't have an order block on this one. It might have had one yesterday, but it's not there now. Thomas, good to see you. Stephen Black, hey man, thanks for telling your dad about us. You are awesome. You are a huge rock star, in my opinion, my friend. Good morning. Only price pays. Patience is key. That's right. Mara, I am reading that. Yes, super great book. It's worth the $10 or whatever you're going to spend on Amazon. Good morning, Jean-Louis. Good to see you. Yannick is here. Can you use the 10 DMA as an entry and exit point? Oh, so the 10 EMA would be entry and exit points for me. ATR is for position sizing, right? So let's break that down. ATR, so down here, let's look at a different stock. Let's look at SPY. And this is really useful, right? Because you can see times when ATR is low, that means the volatility of the stock is low. When ATR is really high, that means the volatility of the stock is high. And when ATR gets really high like this, that's when you start making smaller position sizes because the movements are so much bigger. And in fact, if we go back to that spreadsheet, hang on. if we go back to the spreadsheet here, it automatically calculates ATR for you right here. And the thing is that at the end of the day, you can have the exact same amount of risk depending on whatever stock you're interested in. You can have the same dollar risk by changing your position size. So for example, this is based on share size. Because I can't pull in option prices, it's hard. I mean, that would be impossible. But for example, if we went on Tesla, we could buy 85 shares, risking 2.5. Let's do 5%. There we go. We could buy 170 shares of Tesla with 5% risk per trade, knowing that we would get out at 259.15 if it goes against us, right? So it's got, how much is that? $11 or so. And that would be my stop out point on an ATR 22. That would be half an ATR. So that $11 I'm talking about. So if I bought 170 shares at 248 and went against me up to 259, that would mathematically be a risk of less than 5%. Are y'all tracking there? So that is why it calculates that way. Now, of course, the option sizes is based on the approximate options delta. So this divides basically that by 80 to get to 2. So let's see. So if we had the half ATR here, that applies to all of these stocks. Now, because we position size based on volatility, you can have Coke, which is a $69 stock, and Tesla, a $250 stock, which have very different ATRs, but you're going to have the same total risk in dollars if you base it on the share size. But you can have 2,400 shares of Coke versus 170 shares of Tesla. And because we're basing it on the ATR, the position size based on ATR, which is your volatility, you have the same amount of risk. Isn't that cool? I didn't make that up. I didn't make that up. I learned that from the Complete Turtle Trader. We're going to teleport again. Let's see. We'll teleport one more time. Our last teleportation of the day. I learned that from the Complete Turtle Trader right here. Obviously, this is also in my top 5 book. Fantastic book right here, by the way. And also from Larry Hite. He was the first $1 billion hedge fund manager, one of my mentors, and one of the original market wizards. So I think that's really cool that you can position size based on volatility and have the exact same risk on every stock. And at the end of the day, you need to be a risk first trader because it's the only way that you're going to stay in. Donald should buy more Teslas. Lee says, hit the like button. James says, I need to download that song. We are going to post that song on the YouTube channel probably Saturday. And then just save it to your favorites, my friend. Teamwork makes the dream work. That's right. Robert, good to see you. Steven, you did your part, and I really appreciate that, dude. You are awesome. Who is this random guy on the internet? I love when you guys are picking up on my little cues there. Thank you. Golden Oldie, he called Nancy the other day, and he was like, hang on, we're going to do this. He was like, Nancy, are you there? And Nancy was like,
oh, hey, Golden Oldie. How's it going?
Nancy, when are you going to put your book out?
Well, me and my husband, he's still recovering from getting hit in the head with a hammer, but we should have the book out later this year. The problem, though, is that we don't want everybody to know our secrets, so the book will be $84 million per copy.
Oh, that seems like actually a really great deal, Nancy. I'm glad that you're doing that. Oh, what a service you're doing for everybody.
Yeah, I know. I just don't want it to show up at half-price books, because once it's at half-price books, then anybody can get it.
Well, I'll do my part, Golden Oldie. Or I'll do my part, Nancy, and I'll buy everyone that you sell.
Okay, have a great day, Golden Oldie.
But Nancy, don't go. I love you so much.
Click.
Yeah. Sorry, Golden Oldie. I know Nancy was I know you got your crush on her, but unfortunately, she and her husband, you still gotta recover from that head injury from getting hit in the head with the hammer. But you know. But half an ATR is an exit signal. You're right. And that's my stop loss point. Good question though. Yeah, and and to that point, can you use the 10 EMA or the half ATR? Yeah, my dude. In fact, that's what I do. So the 10 EMA I use as a trailing stop. So I use both, right? 10 EMA or half ATR. So let's discuss trailing stops versus a stop loss. So Hope you guys don't mind. This is Chris's teaching hour. That's kind of what I want the Hangouts to be, is you guys ask questions, me give answers kind of thing. Okay, so imagine that we are in the SPY. In fact, let me throw a couple of things on here. Let me do opening right there. Let's say we get in the SPY right here, okay, on this candle. Now, if it doesn't close under the half ATR, then I hold it. So the half ATR is my stop loss point. That means if it hits this point, I know I'm losing. I need to get out. If it hits this point, this is the market telling me that I'm wrong. If it wicks to that point, if it touches that point, I don't really care. It's only if it closes under. That's when I care. So for example, this one I would keep on. And then you could use the 10 EMA as your trailing stop. Your trailing stop moves with you. Now, this is specifically something Larry Height said to me. He said, when you have a stop, it only goes up. It probably is in that recording that's on my YouTube channel. If you go to the Market Wizards playlist, you'll find that recording. It's probably on that video specifically. He said, specifically, your stop only gets moved up. You are never, ever allowed to move your stop down. So what does that mean? Make this bigger. So for example, if we're using the 10 EMA as a trailing stop, you can see how when the trend is moving, the 10 EMA is also moving up the whole time. And then you come to a spot where it closes under, and that closed right under. I mean, ultra close. You could definitely take your risk off the table. So that would be a solid exit point, because we know we won't catch the tops. If anybody tells you they caught the top, they caught the bottom, they're lying. We know we're not going to catch the top right here. So you're going to give up from 574 down to 568. You know, that sucks. But of course, you still made gains from, let's say, right there to here. You still made $3 on the SPY right there in the span of 10 days. Not bad. Not bad. But it got you into the trade. You knew where to get out ahead of time on your stop loss. But you also had a trailing stop that let you stay in the trade. Now, let's say, for example, that you got in here. Here's a great example. Let's say you got in on this candle here. Okay. The next day, it closed under the 10. And let's say your half ATR was down here. It closed under the 10 and under your ATR. That is absolutely a you better get out point. Because until we get the Nancy Pelosi upgrade, we don't have this side of the chart, right? So this is all you can see, right? It went up, it went down. We don't know how far it's going to go down at that point. And it came back up. So let's say you got back in at the top of this candle here, and your half ATR was here. Now you can again let it run with your trailing stop until this point right here. And I'm telling you guys, this should be something you keep forever. Forever, forever. If a stock closes under its 10 EMA, if it's in a big trend like this, and it closes under its 10 EMA, something changed. There's a fundamental change. Maybe not, I shouldn't say fundamental because people get that construed. There is a dramatic change in the stock at that point. Once it's under that point right there, things are different. And then what happened? Like I say, we don't have the side of the chart at that time. So we can only take a guess at what's happening today, because the 10 EMA is the indicator of your short-term trend. If your short-term trend gives up and closes under, things can go sideways. Smash. This right here. This right there. No, not that one. This one. Right there. Let me make this as clear as I possibly can. This is this clear yet? This close under the 10 EMA, which you can't see the future. But this close right here told you something was about to happen. Man, if this video doesn't get 1 million likes, I don't know what I'm doing. This candle right there told you something was about to happen. And then what happened? This. I don't know what to tell you. If you are not watching the market, yet you have your risk in the market. All stocks are bad. Remember this. All stocks are bad, but every once in a while they act right. If you have your money in the market, it is at risk. If you see it close under the 10 EMA and you are in a big trend, look for something to change. Boom. Now, I'm not saying that that a crash happens every time it closes under the 10 EMA, right? We know that. We know that that doesn't happen, right? But something fundamentally shifted when it came out of this trend right there. I really shouldn't say fundamentally. Let's use a couple other examples. Let's look at SoFi, right? In this big, beautiful trend right here, not once did it close under the 10 EMA until here. And here, all the meme stock SoFi bros were like, oh, it's going to go back up. It's going to go back up. It did. It did. But something changed. Something had changed on this period right here. And then it went sideways. And then it got monkey hammered after earnings. Closed under its 10. And then it went sideways to down. Came back up a little bit. Hit a third order block right here. Closed under its 10 EMA. And then it went down again. And does this make sense? I want the 10 EMA for the rest of your history of time to be a red light, green light for you. In fact, we're going to start using that from now on. If it's over the 10 EMA, that's a green light for me. If it's under the 10 EMA, that's a red light. Something's not right here. Something's not right here. So if this makes sense to you, tell me by typing a 10 in the chat. If this is making sense to you, type a number 10 in the chat. If it's not, type a question. I'll try and answer it. ESAT says, always hit the like button. Mikey Mike says, the Complete Turtle Trader is excellent. It is. And it's also really good on Audible. In fact, we're going to be going to Florida here on spring break. So I will not be in next week. I might just listen to that while we're driving down there. That'd be cool. ESAT's laughing. Mr. Baggins is laughing. Tom, good to see you. I love your streams. If you buy above the 20, can you switch your strategy to a 50 if it keeps increases, or should you stick to your 20? Okay, that's a good question. So, like, let's say a close above the 20 right here on SoFi. You would, let's say, for examples, that would be your entry point, and that's okay. And then you switch to your 50 as your exit point, for sure. I mean, you can have one entry point and a different exit point. That doesn't make a difference. What makes the difference is you following that plan, right? What makes the difference is you looking at the 50 EMA and you seeing it close below there, and you're like, okay, I'm gonna go ahead and get out here. I'm gonna get out now. And then you see it close back over the 20 and you follow your plan. You're like, okay, I'm gonna get back in. And then you see it close under the 10 here again. And you're like, okay, I'm out, right? It can be that simple. It absolutely can. But it can't be done if you don't follow your own plan. Let's see. Yes, Brandon, she's writing a tell-all. ATR, I just use a default. I just use like 14, I think is the default. Yeah, 14 is the default. I asked because closing below a 10 EMA is simple. ATR can change, yes. And so for me, I don't worry so much about the ATR changing. Like, here's an example. ATR went from like 67 up to 87, up to 94, whatever. If I get in and my ATR is at 70, I'm just going to run with the 70 ATR the entire time I'm in the trade. Can you adjust it? Absolutely. Absolutely, for sure. That's up to you. Why the 80 delta in position sizing spreadsheet? That's a really good question. So when I put on a trade, these are my criterias on the options chain. In fact, let me log into my broker real quick and I'll show you. It's always 80 delta. Through my criteria, it always gets me to 80 delta, give or take. I mean, it might be like 74, it might be 82, doesn't matter. It's always in the 80 delta ballpark. Hang on, still logging in. Trader takes a minute to log in. Start live trading. Loading indicators. Manny says that is clear. I know, right? It is clear. Loading account view, loading strategies, loading trade ticket. This is taking ages. It's almost there. It's almost there. Finally. All right. It doesn't matter what stock. It does not matter what stock. When my rules come through, start at 21 days, 250 plus open interest, less than 50-cent bid-ask spread, 20% or less extrinsic value, gets me around 80 delta. Doesn't matter what stock. This is SCCO. Let's look at the 80 delta here. Oh, hang on. It's not going to be great right now because the market's closed. Let's look at SPY. You have to look at something that's liquid in aftermarket, because otherwise your bid-ask spread will get crazy. So let's look at like the 80 delta right here. So 271 on $22 is roughly 10% on extrinsic value. So that's good. That's fine with me. Let's go with Apple. Trying to think of super liquid stocks. Let's look at the 80 delta right here. Let's say $1.09 on 1370. It's a little less than 10%. Let's say $2 on 1165. That's around 20% or so. And that's at the 76 delta. So it's just the way that my rules pan out is roughly always around the 80 delta. Now, the deep in the money options, man, we've so sidetracked today by all these questions, but I'm here for you. Options decay curve. The reason that I go with the 80 delta is, again, Larry Hite, that's like the fourth time I've mentioned him today, specifically taught me this. So when you open image in your tab, when you go with an in the money option, first off, you want to pay as little extrinsic value as you can, because extrinsic value goes to zero on every stock and every time, no matter what. As it's going down to zero, I want to pay as little of that as possible. And at the money or out of the money have basically all extrinsic value. And as every day goes by, more and more and more of it evaporates. So I'm evaporating as little as possible, but I'm still getting the leveraged instrument here. By getting deep in the money options, I'm getting a leveraged instrument where I can buy. Let's use an example. This is going to blow your mind right here. Like, I don't know if you guys can tell, but like, I know my shit. Okay, this is my thing. This is what God put me on earth to do, is trade. All right. So just saying, just putting that out there. When we look at Apple and we look at, where was I going with that? Hang on. Got sidetracked by saying that I know my shit. Look at the money. So if we look at the extrinsic value of things that are out of the money. So for example, the 227.50 on Apple is 100% extrinsic value. This will go to zero unless it goes in the money. And we don't know if it will go in the money. So we eliminate that variable by starting with something in the money. So if we go to the 80 delta right here, this is already in the money. It only has less than 10%, looking at the extrinsic value, less than 10% of the option price will evaporate. Less than 10% of this will decay, if you want to put it that way. So and this is where I was going to go. Sorry, I now I'm back on track here. If I buy it for $13.70 and it's a $215 stock, I'm about to get the greatest deal of all time, because I'm going to pay $13.70 on a $215 stock. So 13.70 divided by 215. So I'm basically getting the stock 94% off. Let that soak in for a minute. By using the deep in the money options, I'm buying this stock. That's a $215 stock. I'm paying $13.70 per share. If we boil it down to it, that's what we're trying to say here. I'm paying $13.70 for a $215 stock, which means I'm only paying 6% of the price. Let me use a different example. Let's use Coke. If I buy the, let's do this one right here. I can spend $2.26 per share to get a $70 stock. 2.26 divided by 70. So I'm paying basically 97% off. That might be a difficult concept to understand. But the point is that by buying these options, I control 100 shares of stock. When I control 100 shares of stock, essentially I own 100 shares of stock. Granted, we got the delta to worry about, but I'm trying to keep it simple. Basically, I control 100 shares of stock, which would be equivalent to 70 times 100, which is exactly what it costs when it's 226 times 100, right? So for $226, I'm controlling $7,000 worth of stock. How does the math work there? For $226, so 2.26 times 100, times number of share or contracts you have here, I control a $70 stock. So I get it for 97% off. This is one of the biggest hacks, one of the biggest game changers when it comes to wealth. If I'm going to buy a stock and I can use a leveraged instrument like this that has very little decay, but I can basically get 95% discount on every share that I buy. If this hasn't changed your brain, if this hasn't changed everything you've ever thought about, I don't know how to help you here. But if it has changed everything you've ever thought about, type a 95 in the chat. Type a 95 in the chat. So yeah, we got lots of 10s over there. Very cool. I'm glad you guys are understanding that. OPP, that's right. J&J just did this, and I got out when Chris told me. Hasn't been monkey hammered yet, but I kept his gains. Let's go over here to J&J. There we go, finally. Yeah, J&J closed under its 10 EMA right here. So something has changed. Dr. J gets it. Something has changed. Lots of 10s. Thank y'all for that. 10 with a southern accent. A 10. John James gets it. Robert gets it. Bulldozer, just listen to Turtle Trader on Audible. It was really good, but the human drama was pretty crazy. I know. Pretty awesome. Yes, only daily charts. That's how I ever look at it. What's the difference between a 10 DMA and EMA? I don't know what a DMA is. Maybe the simple moving average, daily moving average. EMA is exponential. Exponentials move faster than a simple moving average. Let me see. 95s. Very cool. Yeah, it is really, really cool. It is such a hack. Such a hack. How do you risk manage that leverage? Well, you risk manage it first by controlling your position size, which we talked about earlier. Man, this is such a good live stream today. We control your position size. Second, you keep your risk really tight, right? The half ATR. I'm not letting it go whole ATR against me, just a half ATR. So yeah, it's really, really cool. It's such a hack. Hey, Mikey Mike, a great eye-opening explanation. Very cool. Lady Boss says, I'm afraid of options. I get it. I totally understand. And here's the thing, right? You can dip your toe into it. I would suggest opening a paper trading account. Tradier has a paper trading system you can do. We actually have a really sweet deal. If you are an Outlier customer, Tradier will put like $150 credit in your account, which is really cool. But you have to use this link to sign up to do that. And you can start paper trading right there. It's really neat. I don't know all the details of that, so of course check the details on that page, but it's really cool. Do I teach this concept in depth in Outlier? Well, I just did it. Here I am, my friend. I'm teaching it right now. Is there a vid in the library on the in the money strategy? I bet that if you went in the Discord here, by the way, we have yet to even get to the video I wanted to cover today. And then you go over to the VIP Investors Toolkit. And then you scroll up to this section, the Ultimate Trading Power Pack. You click in here. These videos are not on YouTube, by the way. So these are lessons for every single bit of my trading strategy. Every single bit of my strategy right here. I went through and I made like a 45-minute, 1-hour lesson on all of them. How to position size for volatility, amazing returns, analyzing winners and losers, choosing the right option has got to be on here somewhere. Hang on. Oh yeah, there. How to choose the right option strike. Yeah, there's a ton of really in-depth training on all of this. Charles Schwab also has a great paper trading platform. Andy says 95. Good to see you, Andy. No need for the video. It's better when you explain them, wizard trades. And it's 100% free. Yeah. Thanks. Chris's video is a masterclass. Very cool. I appreciate that. And we haven't even gotten to the content I wanted to cover, but that's why I like these hangouts here, because you guys can come, you can ask questions, and then at some point we can get to looking at the video. So speaking of, let's get to this video here. This is 5 stocks a smart money is buying now.
Some investors seem to always make the right moves. Billionaires like Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Manish Babrai somehow buy the perfect stocks at the perfect time. It almost feels like they're playing a different game. Well, they are. The rich aren't guessing. They have data, strategies, and access to information that gives them an unfair advantage. But here's the thing. We can cheat the system too. Every quarter, these elite investors are required to share their trades through 13F filings, giving us a peek into their strategy. And right now, the smart money is making some bold, high-conviction moves. The question is, why? In this video, I am breaking down 5 stocks that billionaires are piling into right now, and more importantly, why these picks. And should you be adding it to your portfolio? Let's start with the first pick, a stock that Warren Buffett has been aggressively adding to his portfolio. Occidental Petroleum, OXY. Berkshire has.
All right, let's look at OXY. OXY. All right, I would not be adding this to my portfolio because it's clearly in a bearish trend right here. In fact, let's go over here on Outlier. I want to see what else we see on it real quick before we jump right into it. OXY. All right, so Warren must have taken the buy signal right here. Even though these buy signals come through, of course, always manage your risk. When it's in a downtrend, though, I would look at a buy signal like this as a buy to close my short. So you could have initiated a short here and then closed the short on this side. But Occidental Petroleum. Now, I know Warren Buffett doesn't care about anything in the next year or 5 or 20, right? He's looking 100 years out. So very different styles. I agree with that. But if we're looking at it today, what I see is the fear and greed got up here to as high as about 67, and that's when that sell signal came. The fear came through, a little bit of greed came back, but now the fear is coming back into it right here. It's down at 42. You can see the sector itself is getting more fearful as well. So let's continue what it says here.
Hathaway now owns over 28% of the company, and Buffett has consistently been adding to this position quarter after quarter. This is one of the most strategic investments Buffett has made in recent years. Occidental Petroleum is an energy giant, focusing on oil and gas exploration, development, and production. The company operates across the United States, the Middle East, Africa, and Latin America, making it one of the most globally diverse players in the energy sector. Buffett has always been a believer in energy as a hedge against inflation. And in today's economic environment, that belief seems stronger than ever. Looking at the numbers, Occidental has a market capitalization of $47.3 billion, making it one of the larger independent energy companies. Over the last year, it generated $26.7 billion in revenue. But what really stands out is its profitability. The company posted $12.6 billion in EBITDA, which is earnings before interest, taxes.
And this is why I say you can have a great company. You can have a fantastic company. Even Warren Buffett's buying this company, but it doesn't mean it's a great stock. I mean, if we look at Occidental Petroleum, it's been going down for a long time, a very long time, months at this point. I mean, this peak came in April. We're nearly a year on, and it's been in a downtrend that entire time. And that's another reason why I say all stocks are bad. All stocks are bad, but every once in a while they act right. And with this being said, right, this is not a stock I would buy right here. No way. But I'm not Warren Buffett. I don't have a 50-year outlook here. He's not going to be around for 50 years, but I don't have a 50-year outlook on this stock. I'm looking at today. What's it doing today? It's in a bearish trend. It's getting more fearful. The sector is getting more fearful. I wouldn't be interested in buying this stock here. Because, you know, it can have all these great reasons why it's great. But at the end of the day, you know where I'm going. At the end of the day,
Only price pays.
and right now, price ain't paying anything. Price is paying negative.
Depreciation, and amortization. That means nearly half of every dollar in revenue turns into pure operating profit before additional expenses. Its net income came in at $2.38 billion, showing that despite oil price volatility, Occidental remains solidly profitable. But what Buffett likely finds most attractive is its cash flow. The company generated $4.4 billion in free cash flow in the last 12 months, meaning it has plenty of cash left after capital expenditures to reinvest in the business, pay down debt, or return money to shareholders. Debt reduction has been a massive focus for Occidental since its high-profile acquisition of Anadarko Petroleum in 2019. That deal left the company with a mountain of debt, exceeding $30 billion at one point. But over the last few years, Occidental has aggressively paid that down, reducing its net debt to just $1.51 billion. From a valuation
Yannick, you and I are on the same page, my friend. None of this matters. None of it matters. Not at all. Only price matters. Only price matters. And there's going to be someone, I know it. I see you in the comments right now. You already got your thumbs on your phone. You're like, oh, shut up, Chris. You know what I'm talking about. You got to have a great company with great fundamentals. You stupid idiot with your stupid glasses and your stupid hat. Yeah, I know. I know you're there. Good to see you. Glad you're here. But the company itself, I mean, the market is telling you right now, nobody wants it. Right? What the market is telling you right now is that there are people screaming sell. And you're not Warren Buffett. I mean, you're going to leave that nasty comment, and that's fine. But you're not Warren Buffett. You're not big enough to change the direction of this trend. You're not going to do it. So don't be the guy who stands on the railroad tracks looking at the trend train and you're like, you turn around right now. You're going to get run over. You're going to get run over all day.
Valuation perspective, Occidental is not expensive compared to its earnings. The company trades at a forward price to earnings ratio of 13.9, which means investors are paying about $14 for every $1 of expected future earnings. Its EV to EBITDA ratio sits at 6.4, meaning its total enterprise value, market cap plus debt, is just over 6 times its annual operating profits. Compared to other major oil companies, these are reasonable valuations, suggesting that Occidental is still attractively priced. But why does Buffett keep buying more? One theory is that he's aiming for a full takeover of the company. Berkshire Hathaway already has regulatory approval to buy up to 50%.
Okay. And to that point, if he's buying it, right, he can do this kind of stuff. You and I, we can't do that. Okay. So don't think you're a genius because you're buying it too. If he has a plan to do a corporate takeover, you got nothing here, my friend. You're like 43 shares thinking you're a baller. You're not doing anything. Okay. All you're doing is jumping on a downward trend where dude's trying to take over the company. We're playing two different games here.
Of Occidental, which is unusual for Buffett, as he typically prefers to own significant stakes in companies rather than outright acquisitions. But the fact that he keeps aggressively adding shares suggests he's thinking bigger. Another key factor is dividends and share buybacks. Occidental has a dividend yield of 1.9%, meaning shareholders get nearly $2 in dividends for every $100 invested. While that's lower than some energy peers, the company has been aggressively buying back shares, which increases the value of remaining shares over time. In the broader energy market, oil prices have remained volatile, with global supply and demand constantly shifting. However, Buffett has always played the long game. Unlike traders trying to time oil price fluctuations, he invests in companies that can generate strong cash flows over decades, regardless of short-term swings. That's exactly what he sees in Occidental, a high-quality, cash-generating business with improving financials and a dominant market position. Buffett is making moves in energy, but Bill Ackman is playing a completely different game. His latest big bet is on a financial giant that controls assets across real estate, renewables, and private equity. Brookfield Corporation. Let's break down why Ackman is betting big on it. Bill Ackman invests in companies that generate steady, compounding wealth over decades.
What is Brookfield? BN. Man, this is loading way snappier than it used to. All right, looking at BN, look, it's like getting dominated in fear. 26 on the fear and greed score. Financial sector is getting dominated. And then you've got this huge downtrend going on, right? If you are a trader, or even if you consider yourself a long-term investor, and you're looking at this and you're like, oh, how juicy. oh, I need to own me some of that. You're looking at it like it's a T-bone steak on a Thursday night at the Saltgrass, right? And you're like, oh, I gotta get me some of that. You can still get you some of that. You could even still get it at the $52, right? You can still get it at $52, like that steak you're going to get at Saltgrass. But you can get it on the way back up, right? You can get it when it figures out its bottom and it starts coming back up. And I don't know where it's going to bottom, and you don't either. And if you're like, oh, I'm going to dollar cost average into this, and you're buying it here at 56, and you're buying it here at 55, right? And then it continues to go down and you buy it at, I don't know, like 45, whatever the case is. If you're buying it all the way down, I don't know if you know this, but this is crazy. If you buy 1,000 shares here, 1,000 shares here, 1,000 shares here, and 1,000 shares here, as it's going down, hear me out. This is going to bother you because you probably aren't going to want to admit this. You're still going to have the same average cost at 1,000 shares here, 1,000 shares here, 1,000 shares here, 1,000 shares here. And that's the thing where dollar cost averaging, the people who want to be these long-term investors, they look at dollar cost averaging as the way to get the absolute best price ever of all time. You can still have the exact same, to the penny, dollar cost average cost of the stocks you own when you're buying it on the way up as if you were buying it on the way down if you buy it at the same places. It's just math. It's just math. So when people are buying things on the way down, this is what they are. All right. If you're buying something on the way down, I didn't say it. Paul Tudor Jones said it. One of the greatest traders ever. Mark Minervini, one of my mentors, wanted to be like Paul Tudor Jones when he grew up. There's no point in doing this. There's no point in averaging down because you will still have the same outcome at the end of the day if you average up at the exact same price points. Deep. Exactly. Losers average losers. DCA on the way up. Yeah, like it's not that hard. It's really not. So many people want to overcomplicate this game, and that's why they get wrecked. They get absolutely monkey hammered. Sorry, I clicked the wrong button there for a second. They get absolutely monkey hammered because they think that they need to load up the boat on its way down. Load up the boat when it's heading out. Don't load up the boat when it's coming in.
That's exactly why he's been aggressively adding to his position in Brookfield.
Graham, hey man, perfect timing on that. How do you do that? Well, it'd be the same, right? If you're buying it at 56, at 54, 52, and 44, if you're buying it at these points here, averaging down your cost. Hang on. Let's do math here. Let's pull out Excel. We're going to get super handy here with Excel. So if we buy it, let's zoom in, make it a little easier on you. Let's say we buy 1,000 and the average price was 56.71 on the way down. 1,000 again at 54.77. 1,000 again at 52.09. 1,000 again at 44.99. All right. So our average price would be what? Well, it's basically the average of all these equals average. Okay. Our average price is 52.14. But hear me out. Hear me out. This is, you're not going to believe this. This is going to blow your mind. If you buy those same 1,000 shares, but on the way back up, right? So you start buying when it's at 44, and again at 52, and again at 54, and again at 56, all the way back up on this side. Hang on. Let's just check the math here. Oh shit, he's right. Dollar cost averaging is a fallacy. Sure, do it on the way up. Doing it on the way down, you don't know how far this is going to go. You don't know. And then you're going to feel really dumb when you bought it at 56, when it's down at, let's say it's down at, I don't know, 26. You can average that again. Well, my average cost is less than your average cost. Well, actually, I also bought it at 26, but that time on its way up. And oh no, the average cost is still the same. Huh. Math always math. And that's what I understand. I just don't get it where people are screaming buy, buy, buy on the way down when they're going to get the same average price when it's going back up. How do you know it's going back up, Chris? If you're such a genius, how do you know it's going back up? With the outlier trend template. When the 10 crosses over the 20 and price crosses over the 50, right? Is that the greatest entry of all time? No. And nobody says it is. But it's a mathematical fact that when those cross, it is a bullish trend. And when they cross down, it is a bearish trend. There's going to be times like this where you get chopped up a little bit. You lose a buck, you make a buck. But you stay out of trouble. So I wouldn't buy Brookfield. But then again, we have very different tastes in stock.
Brookfield Corporation, a company that most retail investors overlook, but one that plays a massive role in global finance. Brookfield Corporation is one of the largest alternative asset managers in the world, overseeing over $900 billion in assets across real estate, infrastructure, renewable energy, and private equity. While most investors focus on traditional stocks and bonds, Brookfield thrives by owning and operating real hard assets, things like toll roads, skyscrapers, power plants, data centers, and even entire city districts. In today's economy, assets like these are extremely valuable. Many of Brookfield's contracts include inflation-protected pricing, meaning the company can raise fees on its infrastructure assets when inflation goes up. This makes it a powerful hedge in uncertain markets. Looking at the numbers, Brookfield generated $97.99 billion in revenue over the last year, an increase from $92.77 billion the year before. But what really makes this company stand out is its ability to convert revenue into massive operating profits. Brookfield's EBITDA came in at $30.69 billion, which means that nearly a third of every dollar it earns turns into cash flow that the company can reinvest. Its net income, however, dropped significantly from $5.2 billion in the previous year to just $1.13 billion. The reason? Brookfield has been making huge investments into expanding its asset base, and these large capital outlays temporarily reduce reported earnings. But that's exactly how an alternative asset giant like Brookfield operates. It reinvests aggressively to keep growing. One area of concern is Brookfield's high debt load. The company has $233.7 billion in total debt. And while that number seems extreme, it's important to understand that Brookfield uses debt strategically to finance infrastructure projects that generate stable cash flows. It's not the same as a tech company carrying billions in debt with no clear path to profitability. Brookfield's assets are tied to long-term revenue streams, many of which have government-backed contracts. From a valuation perspective, Brookfield trades at an enterprise value to EBITDA ratio of 20.2, which means investors are paying about 20 times its annual operating profits. That might sound expensive, but considering Brookfield's scale, pricing power, and diversified asset portfolio, it's justified. So why is Ackman going big on this stock? Simple. Brookfield is a wealth-building machine that benefits from rising inflation, global infrastructure spending, and the long-term shift toward alternative assets. But while Ackman is focused on building wealth through assets and brands, Michael Burry is taking a completely different approach. Instead of looking for high-growth opportunities, he's focusing on stocks that are recession-proof. That brings us to his latest bet, HCA Healthcare. Michael Burry is known for making bold, contrarian bets, but when it comes to HCA Healthcare, his strategy is surprisingly conservative. Instead of looking for the next big market crash or high-risk short positions, Burry is doubling down on stability. HCA Healthcare is the largest for-profit hospital chain in the United States, operating over 180 hospitals and 2,400 care facilities. Unlike cyclical businesses that depend on consumer spending, hospitals generate revenue regardless of economic conditions. Whether the market is booming or in a recession, people still need medical care. The numbers show why HCA is such a...
I don't know why my outlier looks really different all of a sudden. Maybe we're pushing an update like right now as we speak. That's so weird. That's really weird. HCA Healthcare did get a buy signal a couple of days ago. Let's go over here to the charts real quick. HCA. Dude, tell me order blocks don't work. Go ahead. Go ahead in the chat. Tell me order blocks don't work. Go ahead. Go ahead. Go ahead. No. This order block created back here in April of 2024, a year ago. Look at this. You can watch a stock round trip and come right back down to here and bounce right off that order block. Bounce right off that order block. Chris, order blocks don't work. Isn't that crazy? But what else is crazy is that people have held it all the way up. Let's go from this low right here all the way up 34%, and they held it all the way back down. People did that. We know what they did that. But here's the thing, as we talked about earlier, and for those of you who are going to watch this on the replay, you missed a huge lesson. You missed a huge lesson. You should definitely show up on the lives. But we had one close under the 10 right here. And as we talked about earlier, a close under the 10 is a red light, green light for me. Right? If it closed under the 10 right there, that was a red light. It did close back over the 10 right after that, and that happens, right? So imagine red light here, green light again. Red light here. Okay, so we've got a couple of red lights, but we could have made some profit in the meantime. Another couple of green lights came through. First red light under here, red light right here, right? We see it closed under the 10, quite a lot under the 10. And then you had one last chance. You had one last chance to exit when it closed under the 10 before our old friend Monkey Hammer came to town. When this got absolutely demolished, Monkey Hammered to death, you had a red light. If this doesn't open your eyes, I don't know what else to tell you. You had a red light here, you had a red light here, you had a red light here. Price didn't do all that much in between these points right here. But what did change was the trend. The trend started going sideways after this red light. And then look out below.
A strong defensive play. In the last year, the company generated $70.6 billion in revenue, up from $64.9 billion the previous year. This steady growth proves that healthcare demand doesn't slow down even when other sectors struggle. HCA's EBITDA came in at $13.86 billion, meaning that nearly 20% of every dollar earned turns into pure operating profit. But what really makes HCA stand out is its net income of $5.76 billion, which shows that even after accounting for expenses, the company remains highly profitable. One of the biggest concerns with HCA is its high debt load. The company carries $45.2 billion in total debt, which is significantly higher than its industry peers. However, this isn't as risky as it seems. Because hospitals operate with predictable, recurring revenue, HCA has the ability to service its debt without major financial stress. The company also generates strong free cash flow, which came in at $5.64 billion last year, giving it room to continue paying down debt while expanding its operations. From a valuation perspective, HCA trades at a price-to-earnings ratio of 14.4, meaning
I didn't realize I'll scroll down on that.
investors are paying about $14 for every dollar of profit the company generates. This is reasonable for a business with strong earnings and stable growth. Its EV to EBITDA ratio of 9.0 also suggests that, while not the cheapest stock, it is priced fairly for its long-term profitability. Burry's decision to buy HCA suggests he is playing defense. Instead of chasing speculative opportunities, he is positioning for a potential downturn by investing in essential services. While Burry's approach is defensive, Howard Marks is taking a completely different approach. Instead of focusing on healthcare or consumer goods, Marks is betting on a turnaround in the telecommunications sector. That brings us to his latest big investment, Liberty Global LBTYA. Howard Marks has built his career on finding value where others see trouble. His firm Oaktree Capital specializes in distressed investing, meaning he looks for companies that are undervalued, misunderstood, or temporarily out of favor. That's exactly why his recent investment in Liberty Global is so interesting. Liberty Global is a massive telecommunications company that operates broadband, mobile, and television networks across Europe and Latin America. The company owns major telecom brands in the UK, Germany, Switzerland, and other regions, providing internet, cable TV, and wireless services to millions of customers. Over the last few
Let's do a little red light, green light. Let's do a little red light, green light. Green light right here. Green light right here. Goes up. Red light right there. Little red light, green light situation. Let's do that. Properties. Let's change the color from blue to green. Let's change this color from green to red. Little red light, green light situation going on here. Close over. Close under the 10 EMA should always be a red light for you. It's like he knows what he's talking about. I know, right? I know. Anyway, I'm kind of done with this video. Let's see what the last one is here.
Move comes from Monish Pabrai, who is doubling down on an industry that many investors have written off, coal. His latest big bet is on Warrior Met Coal HCC. Monish Pabrai looks for highly profitable businesses that are deeply undervalued, even if the rest of the market is ignoring them. That's exactly why he's making a bold bet on Warrior Met Coal.
All right, let's do red light, green light on this. So obviously it's been red light for a hot minute over here, but there was a green light point. So let's find the green light point, right? You got your 10, 20, 50 cross up. This could have been a green light point. Yes, we're looking at this in hindsight. I know, but it helps to see right here. Right? Even though we had a big, beautiful trend starting, it didn't last long before you got the red light, green light, 10, 20, 50, red light. What happened here after that? Sideways, up a little bit, and then there it goes. I hope this is making sense. This should be something that you keep on your radar. Red light, green light, over and under the 10 EMA. Does it work every time? No. Does it showcase every time there's going to be a crash? No. But every crash will, 100% of the time, have price under the red light. Have price under the 10 EMA. Oh, Mikey Mike says, this has been one of the best live streams yet. Oh, dude. Thank you for that. I appreciate it. We've only done an hour and 10 minutes. And you know what? Because we have gone so long, I'm going to go ahead. I'm going to wrap it a little bit early. I know we could be doing this for another hour and 10 minutes here, but I want to be respectful of your time. I didn't get a chance to tell you real quick what my name is, though. My name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And don't forget, you can get the Outlier Annual Pass for just 82 cents a day over at outlier.com if you're ready to save time, make money, and start winning with less risk. And if you are inside of your trial, just shoot us an email and we will upgrade you, no problem whatsoever. So do me a favor, tell me what you're trading in the chat, and be sure to come back to this afternoon's live stream where outliers like us will save time, make money, and start winning with less risk together as a team. Now I want you to click on one of the recommended videos that YouTube is popping up now, and I recommend seeing you this afternoon. We'll talk soon.